So I've been asked if I could add a little bit of humor to these videos to try to keep people entertained, and I'm sorry I can't. No, I'm kidding. The thing is that this part is a little bit dry, but it's important because it's going to help you be less stressed out while we're going along and you're wondering, is the underwriter going to approve my loan? And so my primary thing that I'd like you to keep in mind is it's not personal. It feels personal, and it feels like you're giving everything private to provide to get qualified for these loans. Your pay stubs, bank statements, W-2s or 1099s, your federal tax returns, all pages. That feels personal, but really what the underwriter is trying to do is determine whether you're likely to repay this loan. Lenders have come up with some very straightforward sort of guidelines on what tends to prove that you or the other borrowers applying for these loans are going to repay that loan. So we start with income. And the underwriter is applying a guideline that's really just a list. It's a checklist. Can they check off each item on the list that they have shown and seen documentation from you that you have this income to qualify for the loan? So starting with W-2 income, that's pretty straightforward. You get your paycheck either every week, every couple weeks, once a month. That's math to determine what is your income each month. And if it's a regular thing and you're getting more and more income over time, that helps the underwriter and everybody be pretty calm and confident. But there are all kinds of jobs out there in this economy. So if there are different things going on with your income where you've been on a base salary and now you're getting some commission and overtime, there are rules about when they can count commission. And the current way it's written is that your base salary, if you've been in your job for 2 years, we use your base salary, of course. And if you've been in your position for 2 years, and then in addition you've been receiving commission or bonus income for both of those 2 years, then we can count it. But if, say, your commissions started after 1 year, now you've only had commission for 1 year, the underwriter is simply not allowed to count it. That's math. That's looking at the date that it started and seeing if it's completed 2 years. So again, it's not personal, even though it feels personal. And we're all sorry about that, but we're trying to help you achieve your goal to get that home loan by providing the information up front to pull your credit and look at your credit score, provide your pay stubs, look at what your pay is, provide your bank statements so we can see from there. This is the other thing that goes into determining whether you qualify. So your pay stubs may look fine, and then we get to a place where the underwriter, we need to see tax returns. So everything's still fine if your income is your income and you've received the W-2 from your work. But what if you've started a side business and you've taken $15,000, $20,000 in deductions to this, but you haven't started getting income from it yet? So those deductions go against your W-2 income. Well, the lender wants to know that, and they want to know if that's going to continue, because if it seems likely to continue to do this job or to have this business that's going to hit your regular income, well, those are expenses that you have that have to be factored into determining whether your income each month compared to the debt that you carry is going to give you a comfortable amount to live on after you've paid the mortgage to the lender. And that's what the lender is concerned with. Is this mortgage going to get paid every month, and we can be as sure as we can be that we're going to make our profit? That's what the lender is. You know what? That helps you too. If you have a payment that's too high and you're uncomfortable with it, you're going to lose sleep at night. And eventually over time you might lose the house if you can't afford it. So it actually serves you to qualify for a loan in the proper zone of your income and the payment that you're comfortable with. And then really that's our goal, is to have you in a home where you're comfortable and making that payment, and over time using the power of time and your payments, your housing payments, to pay down that loan and build equity in that home. Okay, so we've talked through the credit score and income. With self-employed, you're going to have a bit harder time. I'm self-employed. It's a pain to qualify for a mortgage when you're self-employed. The current lending guidelines go off of tax returns. And so I can't tell you any particular line to look at in your tax return to know which part will give you that income for the loan qualifying process. With some businesses that declare certain income on other lines and take some deductions compared to other businesses that have income in different parts of the schedules and have different deductions, there are so many variations that it doesn't help to try to point you to that on this video. The really most straightforward way to do it is to submit an application, get your credit pulled, see what the FICO is, and submit your federal tax returns, and we'll have our experts take a look at that and tell us of how much income we can count for you as a self-employed borrower. So that's pretty straightforward, right? At that point, once we know that your credit score qualifies and you're going to show enough income, and it looks like you should, and then you can know up to what purchase price am I qualified from this amount that I'm comfortable paying every month. What am I qualified to purchase? That gives you and your realtor and the seller of the home comfort, knowing that you qualify for the loan, most likely barring some strange thing happening during escrow.